welcome everybody. Welcome to another episode of Education with the Cryptoverse DAO. If you're catching us for the first time, do remember to like, comment, and subscribe. If you're catching this on YouTube, if you're here live, welcome. Hope you've had a good Friday so far. Hope you continue to enjoy your Friday. Today we're going to be looking at a little bit more on the trading side of things, a little bit more on the technical analysis side of things. We looked at what a technical analysis is last time. And we've got, plenty of educational episodes as well. So, when you do subscribe, remember to hit that bell too, because we drop all kinds of videos pretty frequently. So if you want to know what's being dropped when, that's a great way to kind of stay on top of things. With that said, let's kind of roll right into it. So what is a relative strength index? In essence, it's an indicator, right? It's an indicator of momentum. That's what it is. The relative strength index is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset. So what does that mean? Let's take a look at what that looks like. This right here is an example. I'll show you guys how to get this set up as well. So what you do, this is TradingView. This is the platform that a majority of people use to chart out their, to chart basically, to run their technical analyses and inform the positions that they're about to take, whether it's a buy or a sell, a long or a short, right? So what you do is you go up here to indicators, type in relative strength index. Feel free to bookmark it too. And that's what that looks like. I think I've kind of tweaked the settings a little bit, so yours might not immediately be purple with a smoothing line and this, that, and the other. But in essence, what this does, we talked about momentum, right? And oversold or overbought. The way that this works, it collates over a time period. It collates, I think, average gains over average losses. That's kind of like the mathematics behind it. Last time we looked at another indicator, and what we did was it was moving averages we looked at last time, and we looked at the equations behind it too. So the equation behind this, very simply, choose a time period, right? Specify a time period. Usually it's 14 days. I think that's what comes as standard. That's what I've got as well. And the equation for it is literally average losses over a 14-day period, right? So from up to down, against or over divided by average gains, average ups. And it's visually once again represented on this chart. Now, momentum is what you gauge with this, and also the overbought or oversold nature of the market that you're looking at the minute. So what does that mean, overbought or oversold? You see these bounds? You see these dotted lines? If this line basically breaks below, then you can consider the stock as being oversold. That means the pace at which it moved down will also show you momentum. But once it's down here, oversold, it effectively means, it's got to come back up at some point. Now, bear in mind, that is not a perfect indicator, because you will see long periods where the price can hover or it can come back down and stuff like that. The price could stay overbought for a long time, right? It could do that. So it's not a perfect indicator. It also doesn't take into account any of the stuff that's happening around, like the fundamentals that you would use, the news, the Forex factory stuff. It doesn't account for any of that as well. But what it is, in essence, is a really, really great way to gauge momentum of price action in whatever direction, and to gauge whether a stock is overbought or if it's oversold, in essence. So that's what that looks like. That's how you get set up with it. Very simple. Whatever. The relative strength index, again, like I said, momentum indicator, displayed as an oscillator. That's a line graph. Again, what it does is it takes that equation and it presents it on a graph. It plots it on a graph from 0 to 100. So it's visually represented really nicely. 1 to 0. The indicator was originally developed by J. Wallace Wilder Jr., introduced in his seminal 1978 book, New Concepts in Technical Trading Systems. We can put a link to that probably in the YouTube description down below, so do take a look. Traditional interpretation and usage of the RSI are that values of 70 or above indicate that a security is becoming overbought, right? So when you plot out those lines, you might want to right there see, I think it's at 70. Yeah, it's at 70 already and at 30 already. So by default, you should have 70 and 30 as the upper and lower bounds, whose, breakage indicates either oversold or bought conditions. Popular momentum oscillator developed in 1978. Yep, it is developed in 1978. The RSI provides technical traders with signals about bullish and bearish price momentum, and it is often plotted beneath the graph of an asset's price. An asset is usually considered overbought when the RSI is above 70%, oversold when it's below 30. Yeah. And again, like I said, this is the formula. The RSI is computed with a two-part calculation. Starts with the following formula: RSI step 1 equal to 100 minus this 100 over 1 plus average gain over average loss. The average gain or loss used in the calculation is the average percentage gain or loss during a look-back period. The formula uses a positive value for the average loss. Periods with the price losses are counted as 0 in the calculations of average gain, and periods of price increase are counted as 0 for the calculation of average losses. Standard, like I said, 14 periods to calculate the initial RSI value. Imagine the market closed higher 7 out of the past 14 days with an average gain of 1%. The remaining 7 days now all closed lower with an average loss of minus 0.8%. Calculation for the first part of the RSI would look like the following. Expanded calculation. So that's there for you. Once there are 14 periods of data available, the second part of the RSI formula can be calculated. The second step of the calculation smooths the results effectively. So we looked at step 1 before. This right here is step 2. So 100 minus 100 over the initial, so previous average gain times 13 plus current gain, over previous average loss into 13 plus the current loss, and that's all plus 1 over that equation. Using the formulas above, the RSI can be calculated where the RSI line can then be plotted beneath an asset's price chart. Kind of like this, kind of like what I showed you on the chart just a second ago. It'll rise as the number and size of positive closes. That's basically, the candles. So like this right here, that's a 15-minute chart with an RSI on it and a moving average on it as well. So one of these candles, this is a 15-minute chart. When this candle stops, you'll see a timer over here as well for the current candle that you're looking at. So let's go all the way to the current sort of thingy. This right here, that's a 15-minute candle that started 3 minutes ago, right? So when they talk about when it closes, price closes, that's what they're on about there. RSI will rise. Yep, makes sense. The second part of the calculation smooths the result, so the RSI will only near 100 or 0 in a strongly trending market. So again, gives you a little bit more of a, a bit more veracity to what it is that this information is kind of telling you, what this presentation of information is telling you. If it hits 100 or gets close to 0, like that's indicative of very strong momentum, basically. It can stay in the overbought region for extended periods. That's something we covered a second ago as well. While the stock is in an uptrend, the indicator may also remain in oversold territory for a long time, which can be confusing, but learning to use the indicator within the context of the prevailing trend. Like I said, use multiple indicators, not just the RSI. Use the moving average, use the relative strength index, use the charting kind of analog side of things as well. We've taken a look at trends and trend lines and how to do all of that stuff. Go through all of the education videos and we'll be able to, get you set up in a much better way. What does the RSI tell you? Momentum. Primary trend of the stock or asset. Knowing that is an important tool in making sure that you're reading the indicators' readings correctly. So a well-known market technician named Constance Brown, CMT, has promoted the idea that an oversold reading on the RSI is in an uptrend, is likely much higher than 30%, and that an overbought reading on the RSI during a downtrend is much lower than the 70% level. As you can see in the following chart, during a downtrend, the RSI would peak near the 50% level rather than the 70%, which could be used by investors to more reliably signal bearish conditions like overall in the market. Many investors will apply a horizontal trend line between 30 and 70 when a strong trend is in place to better identify extremes, right? Adjusted overbought level, as you see, it's been moved to 50. Modifying the overbought or oversold levels when the price of a stock or asset is in a long-term horizontal channel is usually unnecessary. So basically when it's ranging, don't really need to, but if there's wild price fluctuations, tweak it dependent on what it is that you're seeing in the market. Like we've said a million times before, we can't predict price, we can only react to it, and these things basically help us react better. That's effectively what all of these indicators and stuff do. A related concept to using overbought or oversold levels appropriate to the trend is to focus on trade signals and techniques that conform to the trend. In other words, using bullish signals when the price is in a bullish trend and bearish signals when a stock is in a bearish trend. That will help to avoid the many false alarms that the RSI can generate. Generally, when the RSI surpasses the horizontal 30 reference level, the lower bound, it is a bullish sign. And when it slides below the horizontal 70 reference level, it is a bearish sign. So if it's above and it breaks down, that's bearish. If it's below and it breaks up, re-enters the channel, that's usually a bullish indicator. Shows you that the momentum is probably going to continue up in that direction, in essence. Put another way, one can interpret that the RSI values of 70 or above indicate a security is becoming overbought and overvalued and may be primed for a trend reversal or a corrective price pullback. And again, vice versa, if you see the RSI hovering below 30, oversold, needs to kind of come back up. During trends, the RSI readings may fall into a band or a range. During a downtrend, it is rare to see the RSI exceed 70, and the indicator frequently hits 30 or below. These guidelines can help determine trend strength and spot potential reversals. For example, if the RSI can't reach 70 on a number of consecutive price swings during an uptrend, but then drops below 30, the trend has weakened, and it could be reversing lower. Opposite's true for a downtrend. If the downtrend is unable to reach 30 or below and then rallies above 30, then that downtrend has weakened, and it could be reversing to the upside. Trend lines and moving averages, again, very helpful tools to include when using the RSI this way. Again, like I said, it doesn't account for the fundamentals aspect of things as well, so always try to be a little bit aware of what's going on in the world. Use Forex Factory, great tool, and use multiple indicators at the same time. And obviously, watch price action, watch trends, draw trend lines, look out for patterns, and just, kind of fortify your position before you take it. A bullish divergence. So let's talk about divergences. What does it mean? It's basically when this behaves differently to this, right? So if price action on average is going down and the RSI is moving up, that's what's called a bullish divergence, right? And vice versa, if you see the price moving one way, so bullish divergence occurs when the RSI creates an oversold reading followed by a higher low that matches correspondingly with lower lows in the price. So one does a lower low here and the other one does like a higher kind of low. That's what divergence is, right? This indicates rising bullish momentum, and a break above oversold territory could be used to trigger a new long position. Again, bearish divergence, basically the opposite, occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher highs on the price. As you can see in the following chart, a bullish divergence was identified when the RSI formed higher lows as the price formed lower lows. This was a valid signal, but divergences can be rare when the stock is in a stable long-term trend. Using flexible oversold or overbought readings will help identify more potential signals. Falling price lows, lower low, higher low. Rising RSI lows. See? So that's divergence. Let's talk about swing rejections. Another trading technique examines the RSI's behavior when it is re-emerging from overbought or oversold. That signal is called a bullish swing rejection, and it's got 4 parts. So first, the RSI falls into oversold, and then it crosses back up above 30, goes down below this, goes back above the yellow line. It then forms another dip without crossing back into oversold territory. So step 1 is here. It's in overbought, right? Crosses down, crosses back above. Wait, what? Why is that labeled 1, 2, 3, 4? It's not in oversold territory. It's in overbought territory. All right. Well, in essence, crosses. So it falls into oversold, crosses back above 30. The RSI then forms another dip without crossing over, right? It doesn't break the line. And then it breaks its most recent high. So as you can see in the following chart, RSI indicator was oversold, broke up through 30% and formed the rejection low that triggered the signal when it bounced higher. Using the RSI in this way is very similar to drawing trend lines on a price chart. Did it break below 30? $40s down here, it didn't really. Yeah, that's an overbought territory. I don't know why it says oversold. But in essence, these are the steps in the process, right? Of a swing rejection. Let's talk about the limitations of the RSI. It compares bullish and bearish price momentum and displays the results in an oscillator that can be placed beneath a price chart. Like most technical indicators, its signals are most reliable when they conform to the long-term trend. True reversal signals are rare and can be difficult to separate from false alarms. A false positive, for example, would be a bullish crossover followed by a sudden decline in a stock. A false negative would be a situation where there is a bearish crossover, but then the stock suddenly accelerates upwards. Since the indicator displays momentum, it can stay overbought or oversold for a long time. We've covered that already. When an asset has significant momentum in either direction. So it's most useful in an oscillating market where the asset price is alternating between bullish and bearish movements. That's the best time to use a momentum indicator. Makes sense. So what does it measure? Relative strength in it. So it's a measurement used by traders to assess price momentum of a stock or a security, whatever it is you're trading. The basic idea is to measure how quickly traders are bidding the price of the security either up or down. How quickly, the momentum of it, the rate at which the price is moving in one direction or another, which indicates relative strength of that direction. In that direction, excuse me. The RSI plots this result on a scale of 0 to 100. Again, 30 to 70. We've talked about the lower and the upper bounds. Usually put below the price here. Don't usually, normally you'd superimpose the moving averages behind the or over the price action. It just makes more sense to put it down here. But then again, do whatever works for you. Everyone has different trading strategies. Everyone has different strengths. So whatever works for you, do it. But generally, people put it down below. And we'll also stack like 3-4 indicators that kind of look similar to this. Again, like I said, there's a TradingView tutorial coming up soon. So we'll cover all of the basics in that. So the reason they put it below is so that they can compare the recent momentum against market price. Now let's talk about a RSI buy signal, right? Some traders will consider it a buy signal if a security's RSI reading moves below 30 based on the idea that the security has been oversold and is therefore poised for a rebound. Like an elastic band, it has a bounce back up. But the reliability of the signal will depend in part on the overall context. If the security is caught in a significant downtrend, it might continue to keep, sticking down below the oversold level for a long time. Traders in that situation might delay buying until they see other confirmatory signals. What is the difference between an RSI and a moving average convergence divergence, a MACD? They both look similar, but RSI and the MACD, they're both measurements that seek to help traders understand recent trading activity, but they accomplish the same goal in different ways. The MACD works by smoothing out the security's recent price movements and then comparing that medium-term trend line to another trend line showing its more recent price changes, right? Traders can then base their buy and sell decisions on whether the short-term trend line rises above or below the medium-term trend line, right? We'll cover that again. We'll cover the MACD in a different educational episode. But this has been RSIs. This has been the Cryptoverse DAO. Thank you so much for being a part of it. I will catch you guys on the flip. Do remember to like, comment, and subscribe. Follow us on Twitter. Follow the Medium as well. Yeah, thank you. Enjoy the rest of your Friday, guys. Ciao, ciao.